We are back. How is everybody doing out there? Hope you are doing well. My name is Andrew Kuhn. Thank you very much for tuning in to the Focus Compounding Podcast. Sitting alongside Mr. Geoff Gannon. Jeff, how's it going today?
It's going great, Andrew. How is it going with you?
It is going fantastic. I am excited to talk about today's podcast. The topic that we are going to discuss is we're going to be talking about pattern recognition.
Okay.
And I don't know if we've actually dedicated a podcast to it before, but obviously it's a pretty good topic to talk about and how it relates to investing. Before we go into that, though, of course, this is the audio part of our business. If you do want to get access to investing ideas, go to focuscompounding.com and be sure to sign up using the podcast promo code, which is podcast, and that will give $10 off the monthly price indefinitely as long as you do stay a member. So pattern recognition, obviously it's a very important topic.
Okay.
And you know who talks a lot about pattern recognition is Jim Chanos. And he talks about at his firm how there's certain individuals or all the PMs or they've all been with the firm for a very long time. Okay. And the reason he says that you have to be with this firm for a very long time before making the PM level is because you have pattern recognition, which is obviously an edge maybe over people that haven't seen things play out. Does a saying go, history doesn't often repeat itself or something, but it often rhymes, something like that along those lines. And I think pattern recognition is a pretty good topic. And we've publicly talked about it before, how when reading 10Ks over and over again and how you say that's the best way to learn, a lot of that stems from pattern recognition. Right. Because then, next time you read about a company, it sort of reminds you of a different company you read and how that situation was, and you kind of flow through with that. And recently, when I was reading about Intercom Communications, how that situation was a reverse Morse trust, I learned about what a reverse Morse trust was, and then we actually came across Ascendant, which was a similar situation. I was like, I knew right away what was going on within the business, and I was that much further along learning about Ascendant because I knew how the back end was working because I studied Intercom and how logistically it was all going to work out. So I think pattern recognition obviously is a good topic to sort of go around. So for you, obviously, what does pattern recognition mean? Okay. And then how do you think people can improve on it, and why is it important in investing?
Okay, well, I wrote a memo a while ago where I did I forget why, but I did a simile or whatever from chess, and I'll do that again here, which is so someone was asking a chess grandmaster this is long dead chess grandmaster, but they were asking him, how many moves ahead do you calculate? And he said, if it's the right move, 1. And what he meant, though, is that by knowing the positions, right, knowing the patterns of what things look like, you don't actually have to calculate that far in advance. And I think a lot of people think that experts in things do it through that they're actually predicting the future by going, okay, well, I'll make this move, then he'll make this move, then he'll do it. And he's going 5, 6, 7 moves deep. A computer does that. But a human being is not going to be doing that. What they're going to be doing is recognizing specific patterns of the position, what's at risk and what's not, and how similar this is from something else, and then just the ways in which it's slightly different, right? So they already are categorizing it as something that they've seen before, right? And then they just look at how it's similar or different. And I think the same thing happens in investing a lot. When people talk about how to figure out a stock, a lot of times I think they think DCF, they think how to make exact predictions about the future. In essence, it's the difference between knowing pattern recognition, recognizing what they're looking at, and just trying to brute force calculate this thing out all the different ways that it could be. And I think that's very hard to do, to take a completely novel situation, something you haven't seen before, and say, okay, well, let me assign probabilities to the future of it, and let me go out 5 years or more and calculate these things, and then work back from that to what the present value should be now. In theory, that works, but I think it's very hard for a human being to do.
Sure. And how do you think people can improve on their pattern recognition skills?
Well, read a lot of 10Ks and stuff, but then also think about why you like a particular company. We were talking recently about different companies, and I was saying that a few of them were all fit a pattern of being a lot less risky than one of the others. And a lot of that had to do with really high retention rate, total lack of liabilities, having cash on hand and no liabilities, and very high retention rate in the business. And that's very different from a company that doesn't have those characteristics. But a lot of people aren't thinking in terms of something like retention rate, right? So unless you have a name for it, unless you are actually categorizing things along that way, you could have seen a lot of stocks but not think about, okay, well, they keep all their customers from year to year, and that makes things more predictable than a company that doesn't have any repeat customers, right? And so I think that, you know, giving a name to the specific categories of what you find is a big part of it.
No, I think that's a great point. Do you read history ever, like on like history in the markets, or was that you that said go and sometimes read like an old newspaper or something? I didn't know if that was you or if I heard more Buffett say about that. But
and I've said that before. I think also about reading investing books.
Yeah,
like I think it's even something like the Peter Lynch books or something are even more valuable now because it is in the market environment that we're in now.
Yeah,
I think way too many people read about things that are now, and they sort of think that it's better because they're reading up-to-date books and things. But you go back and you read things, you know, in the 2010s, you want to read things from the 1970s and the 1990s and the 1950s and get more of a sense of all the different patterns that there are that way.
No, and I think that's great. And for a while, and I haven't done it in probably a few months, but every now and then I like to read case studies. So like things that have happened, like Harvard, I think Harvard case studies is what they actually call it. You could go to their website and you could buy a paper that someone has written up. And I was sort of fascinated with frauds in companies and what caused them, just to sort of reverse engineer it on the long side. And I was reading about like Enron, WorldCom, and all those. And I recently read a book called Shaky Ground, which is about the Fannie and Freddie and like the whole 2008 financial situation. And it's like I'm reading it not necessarily because I think Fannie and Freddie is an investment case today, but really just because I think it's good to read about markets, and then you sort of learn about different situations of what happened and what caused it, and that's just only gonna increase your pattern recognition skills, right? And we always talk about how everything investing in this business is all knowledge is cumulative.
Right.
And I think that goes sort of hand in hand with pattern recognition.
Yeah. And that's a big part of, I think, why people have trouble understanding how Warren Buffett can make a decision so quickly on something.
Yeah, he's seen it all.
Right. But it's because if it's completely something that doesn't fit any pattern, well, he's not going to make a decision on it in 5 minutes. He's going to pass on it for now.
Exactly.
Right?
Yeah.
But if it is something that fits patterns that he's seen before, then he's going to buy it. What he's not doing is sitting down and saying, okay, let me calculate this all out in 5 minutes. That's not what he's going to do, because if it's something he's never seen before, he's not going to have a lot of confidence in his calculation of it that way.
Yeah, and that's why people say, I mean, Warren's a better investor today than he was even 15 or 20 years ago. It's because he has so much built up knowledge.
Right.
He's like an encyclopedia.
And I think that's how people when they do make good snap decisions, it's because they actually have this huge sort of mental file cabinet full of these patterns that they've seen before, and it fits that. And a lot of times things don't fit that, and so you end up passing on a lot of things, or a lot of things would take an incredible amount of time and effort to figure out. But the time and effort you put into figuring those things out now is what forms the patterns that you recognize in future times. And so actually a lot of the value that you get from researching stocks and stuff actually comes from future investments that you make, more than people would think. Like, it's not just that learning about a company today doesn't just give you value about that company. It's actually when you accumulate all those things about, you look at 100 different companies, that's actually what forms your ability to understand things in the future really fast.
Yeah, and that's it. And that's why I always say, I mean, and that's why you always say, just keep reading 10Ks. And it's not because to find the next investment idea per se. Of course, if you come across, that's incredible, but it's because you're building up a knowledge base of different businesses where there's going to come that time, what do they say, when opportunity meets preparation, or vice versa, whatever it is, that's when you could act, sort of heavily and act with conviction. Yeah.
And so, but it's one of the most important parts of what we do, and it's actually one of the most important parts of learning. I think it is the most important part about learning about investing, actually. When people sort of talk about, when they say that they're having trouble or struggling with whatever things, they're putting a lot of time and effort into it. If there is any sort of expertise in investment stuff, it is that ability to do the pattern recognition stuff. It's really not learning the theory behind some things, which is very basic, The actual amount of theory that you apply. I mean, I read The Intelligent Investor and Security Analysis when I was 16. There's not a lot of theory that you need beyond that. You could take that and apply it, especially for an individual or someone investing small sums of money. That's all that you would ever need. It's just applying that over being able to see so quickly what you're looking for.
So it's pretty much just getting the right way to think about investing, and then from there it's just building up a database of businesses and then sort of going that way.
Yeah. And it's also sticking to those patterns that you recognize, which is sort of like the circle of competence thing that Warren Buffett talks about. Not trying to go and invest in things that are not the kinds of things that you've invested in before, that you feel you don't understand that well. And that gets us into the sort of superficial categorization versus what I'm talking about. So I think that if you do develop an expertise in investing, you'll have different sorts of names and categories for things than kind of the generic default things that you hear about. So what we're not talking about is, a pattern recognition is not, large cap domestic stocks or whatever.
Sure.
You know what I mean?
Yeah.
And it's much more about finding similarities between things that might look different at first.
So what do you think's like a pattern recognition of like Warren Buffett, right? What do you think he would look at in a business, right? Alice Schroeder has always written about if it has any sort of catastrophic risk, forget it. He's not even going to take a look at it. He's not even going to think about it.
Yeah, absolutely. That's a process thing he does. It's like the first thing he eliminates.
High marginal business. That's something that he likes to see, obviously.
Yeah. What we talked about recently, I think, is a really good one of how quickly these things can happen. We were talking and I said that there was something you could see even without looking at the balance sheet that told you that this company, what it was is that the free cash flow was consistently exceeding the net income. And so I said, so right off the bat, you can tell this company is either going to be a negative net working capital company that's growing or a positive working capital company that's shrinking. So either it has a lot of inventory, receivables, whatever, and it's shrinking, it's getting smaller and smaller, sort of liquidating, or this is some growing business that has some sort of deferred revenue thing. It's collecting fees up front or something, and that's what happened. But you can tell that is just by looking at the income statement when you have when you've seen this pattern so many times over and over again. Now, can I come up with a formula for that, like a definition of it? Yeah, you could come up with that where you could explain it as a definition of it. But it's easier if you know 5 other companies that look like that you've just seen companies that have free cash flow exceeding net income, and you go, okay, I know how that works, rather than trying to explain the concept of float and how that would show up in the income statement and the free cash flow statement and all that in like a definition sort of way. So this is sort of like looking for the pattern instead of the textbook definition. Right. This is sort of in place of like a formula for something. Is understanding it that way. Yeah.
Yeah. No, and I think that's great. And when you think about Warren, like over his career, even today, he doesn't even use a computer in his office.
I think that's probably a big help.
Yeah. I mean, it's incredible help. I mean, he's not on Twitter, he's not on his phone or whatever. I mean, what's he doing? He doesn't even have a cell phone. I think he does, but he doesn't use it. He doesn't
have a smartphone.
He talked about when Lehman went under or whatever. Did you ever hear that story?
Yeah.
How he like a year later or sometime after they went under, he actually saw that like they left him a voicemail to make a deal or something like that.
Yeah, I think he has a flip phone.
Yeah, flip phone. But if you see what he's doing, and like there's a documentary on it, his routine hasn't changed.
The HBO documentary? Do you mean?
Yeah, he's still reading about companies. Maybe not so much now than he was in the earlier days because he's so familiar, but he's still just sitting there reading and thinking all day long.
Yep.
And even Ted and Todd, they said working for Warren, that's all they do. It's just 12 hours of reading all day long with no distractions. Yeah. So you think about it, if you form your life or you sort of set up your life to be able to do that, right, and cut out all the noise, I mean, just think how even a year, how much you could learn and how much you can learn about so many different businesses. And some people obviously can't do that because they have other jobs or they have whatever going on.
But add up all the time that you have some involvement with investment things, whether it's general news things that you're reading, whether it's whatever things about the overall allocations that you're doing, whatever, and think if all of that was focused on just reading 10Ks.
Yeah.
Right? And there are other things that you can do, but I think for the average person, the thing that's most useful is to really quickly understand the key economic drivers for a business. So to sort of have those patterns of how businesses look. And it's important because I think people get confused with like the S&P 500 index or something. They think an index, the returns in the index are sort of like the returns that you'd expect from the stocks over time in them. But the individual stocks, a few of them will be big winners, but a lot will actually go to zero over a long period of time. And if you really look at them as individual 10Ks and also like over long periods of time you start to have a history with them where you've revisited this company for 10 years or something and you've seen kind of what's happened, you'll get a better idea for how these things work out long term. The most important patterns are the ones where it's something that has a really different long-term outcome. So sort of the things that are extremely low risk of going under at any point, extremely low catastrophe risk. And also, a good geometric return, a good compound annual growth rate possibilities over long periods of time, because there's all sorts of things we could talk about way value investing works and stuff. But being able to identify the company that is on a better trajectory for the next 10 years than the one that might not be is probably the most helpful thing, to see that immediately. Because the other things are pretty much calculated for you. right? There's not much debate over what the PE is and what the price to book is and what the EV/EBITDA is, but there's a lot of debate about what the company's going to look like in 5 or 10 years, how safe it is, right?
And how you're going to get there, right?
Mm-hmm. Sure. And it's getting past the superficial things to sort of look at, oh, this is actually a safe company, but it may not look that way. So, if you can get to the point where you can recognize the things that make a blue chip company safe, and then you can apply those ideas to, okay, well, can I find the same things in like a small company or a company that's not listed on a major exchange or a company in another country or whatever, because obviously if you go and try to buy a blue chip stock in the US, you're going to pay for it.
You know who does that?
Who does that?
Guy Spier.
Yeah?
I think he wrote about it in Education of Value Investor or something. Mm-hmm. I know he's publicly said that when he finds an idea that he likes, maybe in the United States, the first thing he does is he goes and tries to see if he could find a similar business in a different country.
That makes a lot of sense. Sure. Yeah. Because you want to avoid the things that are recognized for it. So, the market wasn't bad at correctly picking the Nifty 50 in the sense that these will be good businesses for a long time, but it bid them up too much. But there are other companies that weren't in the Nifty 50 that had some of the same characteristics. So how do you find that and recognize it and find it in something smaller, something in a different place, or something that's out of favor right now,
Mm-hmm. No, I think that's great. So for people listening, and I know we hit on this so much, but I think it's so important, right, to prove your pattern recognition skills, because that's in itself such a huge skill in investing. That's your sort of your personal asset, I guess you could say, in investing. It's to read 10Ks.
It's to read 10Ks in groups. So it's to read 10Ks by picking 5 related stocks.
Yeah, so like in the same industry, right?
Yeah. And then you compare them against each other and see what's different and what's the same.
And what's the best.
Right. And what's the best. But also so why does this business model work better than this one? Right? Or why does this result in this happening and this other one doesn't? So it's really reading about, we've talked about home builders, okay? It's reading about Green Brick Partners and LGI Homes and NVR.
Yeah.
So there's a lot of different home builders, but some of them are quite similar. But the 3 that I just gave you there actually have pretty different business models.
Sure.
And so even if it was just those 3 were the only home builders you read about, that would actually give you a fuller view of how home builders can work, and it would give you an idea of like why the average home builders returns aren't like NVR's returns are, and things like that. So I think that and the same thing, like we did reports which are on the Focus Compounding website about different MROs, distributors, and so we researched like 3 of them or something, and they all have different business models. They all claim theirs the best, but you get into things about how they distribute things, what kind of customers they focus on, all sorts of things that really get into the product economics and understanding them. And we did 5 or 6 different banks, and you really get into what makes a good bank. You can't really tell what a good bank is until you've researched a few other banks.
Sure.
And so when you research 5 or 6 banks together, then you'll really see how attractive one is. And that's why why I really liked Frost, for instance, or like Bank of Hawaii, not as fast growing as Frost, but those sorts of things, because they just look so different in terms of the deposits they have versus I could look at 50 different banks, and generally I wouldn't find those that I thought had the quality of deposits that banks like that have.
And you know what's cool too, right? When I say all knowledge is cumulative, when you were learning about Frost and you were also learning about Bank of Hawaii, you also were learning about the demographics in Hawaii. Absolutely. And you were also learning about the demographics in Fort Worth, right? And sort of the types of customers that they have in that general area as well.
Yeah.
And you don't know where you're ever going to need that information again. But it's there, that's true, you know, and you could always reference it and pull it out of the cookie jar.
Yeah. And, I owned a supermarket stock a long time ago, and I've since gotten people pitching me different supermarket ideas because they're like, oh, I know that you talked about supermarkets once, and so, here and these are different things. And I have certain ideas about what makes a successful supermarket and what doesn't. There was one that we talked about, and you gave me where the locations were and what their sizes were and stuff, and I was like, but it was how many,
I think you said their gross profit that was better than most, or something like that. I forget what we were looking at the numbers briefly.
That if their gross margins were better, their operating expenses weren't that high.
Yeah,
so I was saying their operating expenses as a percent of sales wasn't that bad, so if they could get their gross margins up, it would be okay. But they didn't have clusters, local area clusters that I was expecting, and their size of the stores weren't big enough. You want to cluster large stores in certain places to get the lower cost there. But the point is, by just asking a few questions, we got to some of the economics and what the problems would be of that business, which is you need greater concentration in a local area to achieve the economics that I want to see with a supermarket. And we could answer that question pretty fast.
Because you've studied it in the past.
Right, and I've seen what ones work and what ones have trouble with that, and what sort of things do that. Now, you could probably go find someone who's been a successful investor in supermarkets or is a CEO of a supermarket company or something, and talk to them and say, how does this business work and whatever, and maybe they could explain it the same way to you. But that's what it is. You're kind of trying to figure out what makes this business successful and what makes this other one not successful.
Yeah.
And so I think you have to come up with different categories, different patterns that you're seeing that are different from the sorts of ones that most people are carving the world up into. You don't want the sort of very superficial ones. You don't want, okay, this is an airline stock.
Yeah.
You want to understand, well, is one airline better than another airline? What other industries are airlines like? Sure. Those sorts of things. And so it isn't about, you have to get past that superficial part. And a lot of it is that when I talk to people, that's kind of one of the biggest things, is taking a pattern that they have from some other industry or something and applying it to this particular one. Like when you go from industry to industry, it's almost like they forgot everything they learned about company in another industry.
Yeah.
Right? So they learned about cruise lines or railroads or something, and now they're going into airlines, and it's like they're starting from square one, right? Where there should be so much that you can take from those other industries. So much of those things have analogs in terms of the aspects of the business in this other industry, and that's the kind of patterns that I'm talking about. And those are things that you find out for yourself. They're not so much things that you'll read about in a textbook on the industry or something.
No, and I think that's a great point. And to obviously improve on that, it's just keeping your head down and reading about a bunch of different businesses, I would say.
Mm-hmm. Absolutely. With a focus on what makes the business successful or not. And definitely I'd say reading them in groups. So many people
I think that's the
focus
best thing
on
to
one
do.
stock in an industry, like because they hear about that stock or whatever, and they learn about that stock. And I'll ask because they read a write-up or something, and that's why they're reading about this particular bank or something. But I'll say, so, what is it about this bank compared to banks X, Y, and Z that makes it so attractive?
Like, it just looks cheaper.
I haven't read about X, Y, and Z. Okay, well, but then go out and read about X, Y, and Z so that you can compare it and see. It's one of the first things you want to do in any industry,
No, I think that's great. And I've talked about it when I was in analyzing a bunch of businesses in the home builder industry.
Mm-hmm.
I felt like I got so much out of it, much more than if I just read about Green Brick Partners when I read about 4 other home builders.
Yeah, and sometimes you have to expand that circle of competence, and that's hard because to do this, it means that when you go and read about your first real estate company, let's say, or something, it's going to be impossibly difficult. You're not going to feel like you understand anything about it. You're not going to want to buy the stock, But once you're on your 10th, then it's going to be very automatic.
No, I completely agree with that. And I think that's a good takeaway for a lot of people to sort of add to their own investor toolkit. And it's been the common theme here. I think if people ask how to get better, how to improve pattern recognition, how to become, whatever, I just center around how to become a better investor, the answer has always been the same. It's just continuing to read 10Ks.
Yeah.
Learning about a bunch of different businesses.
Absolutely. The one thing you might want to add to that for people listening is they might want to come up with a question about why they're reading this 10K and write it right on the front of that 10K. Because so many people, I think, can get lost in what they're doing. So write down, why does NVR have the highest returns on capital in this industry or something? And that can be your thing that you're trying to figure out or something. So you have more of a purpose while you're doing it. I think that can be really helpful because so many people get lost in the breadth of the 10K that they're reading, and they lose track of the thread that they're really trying to figure out.
That's what Munger always says. You have to keep asking why,
yeah.
and then hope for a few insights.
Yeah, absolutely.
And I think it's a good way to do it. It's actively reading it. It's not,
Yeah.
I mean, you always talk about how when you decide to read about a company, that's the only company you dedicate to reading that day because it's a very active exercise.
Mm-hmm. Absolutely, yeah.
I think that's a great point. Cool. Any other thoughts on the topic?
Nope, that's it.
I think that was a great discussion. Well, we want to thank everybody for tuning in and listening to us here today at the Focus Compounding Podcast. If you do want to get access to Geoff's weekly memo that we do send out, this was an investing topic episode. Geoff does send out a weekly memo on an investing topic himself. And if you go to focuscompounding.com, on the homepage, you'll see a spot to enter in your email, and that will put you on the list to receive that from us once a week.
Mm-hmm.
All good.
On Sunday.
Some point. We say Sunday morning. Sometimes, actually, one time it got sent out on a Monday, and I put Geoff's Sunday morning memo, and then in parentheses, on a Monday. So it's all good. It's just the title we're rolling with.
So I'm sure you have a topic like this. I'm sure there'll be a pattern recognition one.
Yeah, I think it's a good one to talk about. We want to thank everybody for tuning in and listening with us here today. We do thank you for tuning in, and we'll see you in the next podcast. Take care.